Hi, guys. I'm Darlene Holbrook with Keller Williams.
And I'm Jim Holbrook. And I was just thinking that there is so much stress going on in the world these days. Could you imagine going to bed and being woken by an earthquake and realizing you have no insurance?
Well, I would sleep better at night because we do have insurance. And because of our next guests, we are so well protected.
So, we'd like to introduce you to two guys that we have known for over 20 years that have done such a fantastic job, Dennis and Jake DeGennaro of DeGennaro Insurance.
Welcome, and we're so happy you're here.
Glad to have you guys.
Hey guys.
Hey Jim, how you doing?
Hey
All here.
Darlene.
We've been focusing on the health crisis, and April just wished by, and it's earthquake month. So talk a little bit today about why it's important to update it and also to have earthquake insurance.
Yeah, I think I want to just touch on the fact why most people don't buy it, right? And that's the deductibles are very high, right? And that's our number one barrier to entry with most people, and why most people don't have it, because your homeowner's deductible is a flat dollar amount, right? It's, most people typically have a deductible of $1,000 or $2,500. So if you have a claim, the deductible is your portion of the claim that you have to pay. Earthquake deductibles, they're percentage based, and they're a percentage of the coverage, right? So typically on an earthquake policy, we'd see a deductible of 10% or 15%. So, if you have $600,000 in coverage on your house with a 10% deductible, that's a $60,000 deductible. And again, it's 10% of the coverage amount, not 10% of the damage. So people see that, even people that want earthquake quotes, typically once they see those numbers, they kind of get scared away, and they don't buy it. But the problem becomes if there's a major catastrophe, no matter where you are in your life of home ownership, if you almost have your house paid off and have a ton of equity in it, or if you've just bought your house and have 29 years left on your mortgage, you probably don't want to be spending, or potentially spending hundreds of thousands of dollars of your own money to make yourself whole after a catastrophe.
Let me just piggyback on that, because so he gave you the coverage aspect of it, and then I'll take you back to 1987, where I was in claims handling the Whittier earthquake, and I walked into homes where a slab was cracked or a house skipped off the stem wall, the foundation, and you're probably looking at a couple $100,000 or more worth of repairs. So to Jake's point, if you have a $60,000 deductible, it sure seems like a lot. But if you have $200,000 in damage and they hand you a check for $140,000, you're pretty happy. It might not be enough, but it's not, you're not putting out 200,000, you're putting out 60,000. So it makes it a little bit easier to swallow. A lot of times people think my deductible is 60,000. I have to come up with 60,000. No, it's deducted off of the amount. So $200,000 damage, less 60. Here's a check for 140,000. And back then in 1987, I was handing out checks left and right, for 100,000 plus, and people were pretty happy that they were getting that money.
We're talking about back in the 80s, where $100,000 probably it went a long way.
Yeah.
Further than today.
What do you guys say to clients who just expect that FEMA is going to take care of things?
Yeah, that's a great question. And Jim, I get this question several times a year for FEMA, to the point where I've had to, just for my own knowledge, I've had to dig into what FEMA is and what they're there for. FEMA's there for basic survival needs. Okay. They're there to make sure that people don't go hungry, people temporarily have a roof over their head. And they have two different programs. They have a grant program. The maximum payout under the grant program, I believe right now is $33,000. Okay, that's the maximum FEMA payout under their grant program. But again, this isn't for, your spare bedroom is damaged. This is for you need food, you need shelter on a very, very temporary basis. I think the stat I read that after Hurricane Sandy, the houses that were flooded, the average FEMA grant payment was $8,000. Okay, so if that gives you, any indication of what it's there for. And then they also have a loan program. It's more of a low interest loan, but you do have to pay it back. I think it's amortized over 30 years. But that's very different than a grant. Grant is essentially free money that you need. And now if you get a loan from FEMA, let's say, you're going to add that on top of the loan you're paying back to your mortgage company, right? Because that doesn't go away. So now if you go that route, if FEMA approves your loan, you've basically added another mortgage, right? So if you have one mortgage, now you have two. If you have two mortgages, now you have three. That's not a great situation for people.
So if you don't have earthquake insurance and we have the big one and your house is damaged significantly, you've lost a house and you owe the money.
Yeah, and just from FEMA's website, a couple lines that I wrote down for today. So one of the things that the website says is the assistance is not intended to return homes to pre-disaster condition. Okay, it's basically just, get you functioning water, get you functioning gas. Do you have four walls around you? Okay, you can sleep in the house. That's basically what it's there. Okay. The other line that I thought was really important is that the program is, and again, this is directly from FEMA's website. It's intended to meet the survivor's basic needs and supplement disaster recovery efforts. Okay, so nowhere in there should that give you a warm and fuzzy that FEMA's going to come in and make sure that you have your beautiful house the same way it was before the earthquake, right? It's very, very basic survival type of needs is how the program is designed, and most of the money you would get from FEMA would be in the form of a loan, not in the form of a grant.
Yeah.
Let me jump on that too with FEMA back in 1994 when the Northridge earthquake hit. That was a sad time. If you can remember, and you guys might remember this, that the housing market in California was getting depressed, and people owed more on their loans than their houses were worth. And once the earthquake hit, a lot of people just walked away from their homes because they didn't have earthquake insurance. They owed more than it was worth. So, and you remember that, and there were condos and what have you where people just walked away, and that's when the investors came in and bought them up. But FEMA, I used to listen to people going, oh, we don't have earthquake insurance, but we hear FEMA's going to come in. So the average check back then, what was the average check now, Jake?
So in what I read was Hurricane Sandy, the flood from Hurricane Sandy, the average was 8,000. I think the max grant today is 33. But pretty much nobody gets the max.
Right. So back then it was there was an average of 1,500, and I think the max was 5,000 back then for FEMA.
Wow. What year was that?
That was 1994.
Yeah,
so
okay.
people walked away from their homes at that point because they couldn't repair them. And that was sad too. You had two houses next to each other. One had earthquake and the other one had FEMA, and those people were, they had to walk away. And keep in mind that earthquake coverage, you've got dwelling, you have contents, you have loss of use. Contents, I don't really worry about, because what are you going to lose? You're not going to lose your bed. You're not going to lose your refrigerator. You know, you're not going to lose some glassware, your computer. But loss of use is a critical coverage, because that's the amount of money you get while they're rebuilding your house. So how much do you need to go rent a house? $4,000, $5,000, $6,000 a month. So that's another critical coverage that's within the earthquake policy.
Right.
So that's something I kind of wanted to bring up is a term I think everybody needs to know is demand surge, right? We saw a demand surge after the fires, where there's so many people displaced that there's not enough rentals available for everybody. All these people need short-term housing. So now what happens, right? There's a surge in demand, and the cost to rent these homes just goes through the roof. Same way with the construction costs, right? You have so many people that need their homes, rebuilt or fixed, and you have a limited number of contractors. So now those contractors get to pick and choose their jobs, and the cost goes up, So if your house just happened to burn down and it was just a one-off house that burned down, you wouldn't experience demand surge. You'd be looking for contractors in a normal market. But if your entire street burned down, every house on your street burned down, which is what we saw in the fires, or if a city lost, 10% of their homes in an earthquake, you're going to see demand surge. And for you guys, I'm sure you remember when the Porter Ranch gas leak happened a couple of years ago, right? And you had people that had to go get short-term housing, move out of Porter Ranch for, 3, 4, 5 months. And I remember seeing the prices they were paying to rent houses. It was astronomical. And that's an example of demand surge. So, that with an earthquake, you would absolutely have demand surge, because, anytime you have a lot of people displaced, or a lot of people need, houses rebuilt, houses fixed all at the same time, the supply and demand curve, it's out of whack.
And apparently I heard, and you can correct me if I'm wrong, the insurance company released several homes, or if not all the homes that were burnt out in Thousand Oaks at the same time. So then you had that price surge, is what you're talking about, Jake. So
yeah, because they all burned at the same time, right? So you have all these people that are on the same timeline, right? With hiring contractor, going through the city permit process, and the same thing would happen with an earthquake. You're not going to see it in waves, an earthquake, it's going to be an event, and pretty much everybody is going to be that has damage is going to be, going out to market, looking for housing, looking for contractors, all at the same time, So again, you going back to the analogy that we're using, if you have a house and it's under normal circumstances, it would be $600,000 to rebuild. It's not a stretch to think that with demand surge, it might be $700,000 to rebuild. It might be more. So that's a scary proposition, because then you're talking about people have earthquake insurance, have what is feasibly adequate coverage, but you really can't account for the demand surge, So even those people that feel good about, maybe their reserves, maybe the amount they have in the bank, being able to handle the damage themselves. When I do bring up the topic of demand surge with people, I think it gets them thinking in a way that they haven't thought about it before.
absolutely.
Well, and that's a big reason for, I think, having the insurance. As you said, Dennis, it's the replacement that's key. During Porter Ranch and during Woolsey, we were just hammered for months finding relocation companies who were hired by the insurance companies to find places for people. And then we encountered people who didn't have that assistance, but they also needed assistance in finding a place. They were out of luck.
Right.
Because they don't know what they did, because a good example is we had one property that was vacant and the owner was trying to lease it for around $4,000. The insurance company came in and there was no gouging on behalf of the landlord or anybody. Insurance company just said, we'll give you $9,000.
We'll
Like,
give
You're
you
kidding.
9,000.
9,000.
Right, right. Also, and to piggyback on Jake's point, when there is an earthquake, everybody becomes a contractor. All of a sudden, you've got all these GCs coming out of the woodwork. So, you know, they're going to do it for this price. If you have earthquake insurance, you can look to the insurance company for help in finding a contractor.
Oh.
I mean, they've got a preferred list. So that helps also.
That's good.
So how long does the loss of use continue? Let's say it does take a year to get approval to rebuild, because a lot of friends that we know that had their houses burnt down, the foundation had to be rebuilt as well because everything melted underneath.
Right.
So how long?
So there's a dollar amount on the policy. Most people will be in a situation where if the policy does have a time component, say that, you know, they say your loss of use coverage will only pay it for 12 months or 24 months. If you have an earthquake policy with a time component, I think most people will use the coverage up before any time component would come into play.
So we're talking about kind of intermingling earthquake and fire here, but regarding earthquake, what happens to, and this question comes up all the time with condos. What happens to a homeowner buys a condo and the condominium or the HOA does not have earthquake insurance?
It's a great question. That's a great question. You're in big trouble. You're in big trouble.
Yeah.
The condos that don't have quake is going to be a bad situation. You know, for the unit owners that cover the interior of their condo, you know, they'd probably get paid out the policy limits. But if the HOA can't fix the exterior of the structure, they're probably looking at walking away.
Yep.
Can an individual get on their condo policy some kind of earthquake coverage, loss of use?
Well, you can get the earthquake coverage, and then, like Jake just said, they would pay out limits. So if you take earthquake coverage out for $150,000, yeah, the insurance company will pay you that $150,000 limits if it's destroyed. But what are you going to do with $150,000? You know, if your condo is worth $500,000 or $600,000 or $700,000, you know, that's all you're getting.
Correct.
So yeah, you can take earthquake coverage, but you're still going to come up way short. So
even with that $150,000, it's not like you could fix your unit only. If there's structural things that need to be fixed with the building that the HOA doesn't have money for. So really, in this scenario, the $150,000 check you have, it's nice, you know, and hopefully gives you a fresh start somewhere else. But if the HOA can't repair, you know, the exterior and make the structure safe for living, you can't even use that $150,000 to spend on the interior of your condo.
So that's very interesting. And so when there is an earthquake and there's, let's say, broken pipes in the inside of the house caused by the earthquake, obviously, homeowners insurance does not kick in at all.
Correct.
They don't. So
correct.
No.
Yeah, correct.
I have earthquake insurance.
You do?
Yes, I do, Jake, because of you and Dennis. But what I like about you guys is because on one insurance company, their policy was going up crazy amount every year. And you researched it for us and you got us into a equal policy for a less premium, which is
right.
Awesome.
But when you go through a broker, you know, somebody like us, and we have access to multiple products, we can explain, hey, Darlene and Jim, here's the rate with CEA. Here's what they cover. They don't cover the pool. And, and at that point you go, well, they're out. I mean, even if their rate was half, if you have a pool, there's no reason, So, we have to have conversations like that. We as brokers have to understand things like that. So again, people get surprised when I tell them, hey, you have a CEA policy and that's great, but your beautiful pool in the back, it's not covered. And then, what are you talking about? Well, look here, we'll pull up the policy and we'll show them, here's the list of exclusions. And that's a biggie, and CEA does that for a reason, because, if we do have an earthquake, the number of people that might completely lose their home is relatively low compared to the number of people that might have some minor damage, whether it's to pool, swimming pool, concrete, masonry fences. I've got a block wall surrounding my property that's was built when the property is built, and you can see the cracks in it just from the settling and everything. And I don't know how well that would withstand an earthquake, but I know to replace that all around my property, it would be significant. So looking at things like that is a really important component, and it's kind of a reason why having earthquake insurance isn't just a yes or no thing. You have to look at, okay, are the walls covered? Is there a sublimit? Is the swimming pool covered? Is there if it is covered, is there a certain dollar limit it's covered up to? Things like that become really important.
And that is very important. And that's what I like about both of you, because you ask the proper questions and you give them the appropriate insurance. And I always feel comfortable sending my clients to you. Oftentimes, and we do pay, I'll be straight, we do pay a little bit more, but we get so much more from you guys. I can call you on a Saturday, which I have. I've called you during the week. I've called you just for superfluous questions, and you always answer. You always call me back. You always, you just give us good information. So, so thank you for that.
Yeah, Jake, I found a couple Yelp reviews that I just wanted to share about you. One was from one of our clients. I forgot. I read this and I go, hey, she's our client. She said, insurance is not fun, but Jake is cool and makes it infinitely less painful. That's it.
That's what we're aiming for. Less painful. That is our benchmark. Pain. If we can get less pain, we're good. The other thing that I wanted to touch on with earthquakes, I want to make sure everybody knows the word moratorium, which moratorium is a powerful word in our industry. And basically what it means is that if there is an earthquake, CEA can't shut down new policies. They can't say, hey, we're not going to issue new policies, but the other carriers can. The private earthquake insurance companies can. So if there's an earthquake, last year we had the Ridgecrest earthquake, right? Once that happened, all the private earthquake insurance companies said, hey, no new policies in any of these counties. Usually the earthquake moratoriums are for about 60 days, okay, after the seismic activity. So for the people who think, hey, if there's an earthquake, maybe then I'll think about getting earthquake insurance. The choice might not be theirs at that point, okay? And with CEA, it's really interesting because we all think of an earthquake as a single event. CEA, in their coverage, they define the coverage for seismic activity, okay, as 15 days after an earthquake. Okay, so what that means is that if you have an earthquake today, any of the aftershocks related to that earthquake that are on the same fault within 15 days become part of that one claim. Okay, so if you have maybe some damage from the initial earthquake and maybe then you have more damage from the aftershock, they're not going to look at that as two claims or multiple claims. They look at that as one claim. So that's a good thing. And all carriers have a range of, what they define as earthquake activity. Some carriers are 7 days, right? So there's some protection for people that those aftershocks are going to fall under one claim. But with CEA, if you have an earthquake today and you want to get your CEA policy tomorrow, they can't say no, but they're not going to cover any of those aftershocks because it's all going to go back to the coverage. The seismic activity date would have started from yesterday. So any incidents related for the next 15 days to that first earthquake would go back to the date of that initial earthquake. And if you didn't have your CEA policy at that point, none of the aftershocks are going to be covered, even if you buy it the next day.
And let me say something here. If earthquake insurance was free, everybody would have it. So really the point of contention is the premium. You don't want to pay that premium. I don't like paying that premium either. I write that check once a year. I think my hand shakes as I write the check because I really don't want to write the check. But I write it knowing that when my house starts shaking at 2 o'clock in the morning, I can just lay in bed and really not worry about it. I have the coverage. What am I going to do? The house is shaking. If it has damage, I've got coverage. But if the house is shaking and I didn't write that check, I would be scared to death. And let me go back to also the underwriting aspect of how we look at things. When Jake came into the agency, keep in mind, I started in claims. I didn't start in an agency. So I did burn downs. I did earthquakes. I saw people outside their houses with burned feet after their houses burned down. When Jake came into the business, he didn't come into the business learning sales. There's no need to. Jake came into the business learning claims. Every house you look at, you have to look at it if it burned down. There's a wood roof, comp roof, tile roof, stucco, veneer, what have you, pool, block walls. That's the way he came into it. So when he looks at everything, he looks at everything from a claim standpoint of doing what's best for the client, not anything in regards to sales. Because there's nothing like a feeling of going up to somebody you knew or know and seeing their house burned down and them sitting outside on the curb and fire engines and paramedics there, and they have nothing but the clothes on their back. Then you start looking at things at a different angle when you start writing that insurance.
Right, and that's specifically the reason why I have earthquake insurance, so I can put my head on my pillow and fall asleep, and if the house shakes in the middle of the night, I can fall back asleep.
Absolutely.
better
and let Jim deal with it. Jim go take care of it. I'm going back to bed.
Yeah.
Right.
Depends on the magnitude, I guess, but
Yeah.
It's better our handshakes writing that check than shake in bed, like you said.
There you go.
That's right.
Absolutely.
Darlene, are you more likely to go back to bed if it's a higher magnitude or lower magnitude?
Absolutely not. Absolutely not. No, I'm up trying to find out where it is, center, and it's so much easier now because of your phones. But it's pretty serious, and that's why you guys have schooled us. We've sent our clients to you. The importance of earthquake. We get that question every time. Should we get earthquake insurance? And I say absolutely.
Well, you guys through the years have done that constantly. Dennis, you mentioned the fact that you're claim based. That's where you started in the industry. And most people, I think of an insurance agent as selling me the policy. Like, for example, if you're a AAA or somebody, you talk to one person to buy the policy, but then when you have a claim, you're dealing with somebody else.
You are, yeah.
And we've had some claims, haven't we, through the years?
Some good ones too.
Oh yeah, how about that?
Really unique claims. I recall
in the Claim Hall of Fame.
I recall a dog in the back seat of a van or something.
Yeah, so I rented a van to go down and see my folks, and I wanted to bring the dog. And we're driving home late at night, and I'm going, wow, she's sleeping. I must have tired her out. So quiet. Got in the garage, opened the door, and she had chewed the entire back seat up over 3 hours driving back from San Diego. So I thought I was screwed. And Dennis, you just said, let's keep trying, let's keep trying, let's keep trying. And you came up with an argument. I mean, you were brilliant. You were like an attorney.
Well, in claims, you have to find a trigger. There has to be a trigger that, and that's what they look at, and it will trigger coverage. And I don't want to speak poorly of insurance companies, but it really depends on the adjuster. Some adjusters will look for the trigger, and some adjusters won't. So, I think Jake and I get a little bit more involved in claims than your normal agents would. I mean, I have been told by claims adjusters, please back off a little bit. We'll take care of this. But hey, look, people put their trust in us. So when there is a claim, we are going to do everything we can. If there is coverage, then we want to make sure we're there to facilitate that as much as we possibly can. We had a claim, I don't know, maybe a month ago, where one of our clients had a newer Porsche, spent 120 grand on it, and a rodent went in and chewed up the wiring harness.
Yeah.
And it was going to be about $5,000. And his first response was, I know this is not covered, but I wanted to just ask you anyway. Well, of course. Okay, time out. Let's look at this. Let's get it in there. Let's have the adjusters look at it. And lo and behold, when it was done, it was covered. And obviously the insured was pretty happy. And we got involved in, a little bit in that, basically just to let the adjuster know, hey, we're here. We are watching this. We do want to know what's going on, just to let them know somebody is keeping an eye on it.
And that's
so I think that's just second nature to both of us to do that.
Yeah, I think that's very important, because we don't know the jargon. We don't know what the next steps are. And that's why we have had you guys for over 30 years, because I call you up, you explain it, and then you probably have to explain it to me again, but it gets done. Everything gets done, and we are always happy. So
well,
we appreciate it. And Jim, the dog story about the car, that's the reason we hold our breath anytime you call now.
Right, exactly. And our last name.
Not yet.
Yeah.
Our last name is DeGennaro, Italian heritage. And we have a very simple motto that we learned from The Godfather. We make them an offer they can't refuse, and then we get things done.
Well, and I resonate with that, because I'm Italian too. So
right.
I get what you're saying. Yeah, those offers.
Well, listen, guys, we could go on all day as always. You're so easy to talk to.
So great to talk to you.
I miss you guys.
Yeah, we
Totally.
Too. Thanks, you guys.
Okay.
Thank you so
Thanks
much.
for doing this.
Appreciate
Have a
it.
great weekend.
Talk to you soon.
You too.
Bye-bye.
See ya. Bye.